Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the first weekly economic review of the year 2025. First, I want to wish you a very happy new year. All the success in the world. Is going to be a very interesting year in the markets, in politics, on the economic side, but we'll be there with you to make sense of all of this. So this review will be a bit longer than usual because I want to take time to look forward to 2025 with you here. Before we get started, let's maybe look at the returns on the market this week. At the close on Wednesday, because on Thursday there was a national holiday in the US because markets were closed because of Jimmy Carter's funeral. Still, year to date, bonds down, interest rates are higher. We'll discuss that in a minute. And the stock market is starting the year with positive returns, so good news so far. Price of gold higher, price of oil higher. So somewhat of a bullish tone on stocks to start the year, negative on bonds. Overview of the markets in 2024, as you can see here in this chart, in this table, and I brought 2023 as well just to show how both years look alike. So rebound in 2023 in bonds, the rebound continued in 2024. For stocks, the TSX had a solid acceleration from about 10% to about 22% in 2024. So good years back to back, but S&P 500 returned about 25% both years. The Nasdaq was at about 40% in 2023, 30% in 2024. But if you're a Canadian investor, it's 40% for both years. So very solid years here. And of course, that brings with it questions about valuations, and we'll discuss that in a few minutes. Valuations are not that useful to time the markets in the short run, but in the long run, they're very determining factors of expected returns. So here we need to ask questions about the long-term potential of outperformance of the S&P 500. We'll discuss that in a few minutes. Price of oil rebounded a little bit. The price of gold was one of the stars of the year. Now in 2025, the factors that pushed gold higher last year might be reversing. Synchronized rate cuts, well, with the jobs report that we had this morning in the US, the Fed now is priced to stay on the sidelines until September or October. So we're not talking about will they cut again in January or not. Is it will they cut before the end of the year, let's say before the fall? We think maybe that's a bit too much. Likely that will bring some interesting trades through the year, but so far this is not as supportive of gold as it was in 2024. And geopolitics, we'll see how things turn out next year, well, this year as well. So gold will be an interesting asset to follow. So to look forward to 2025, I thought that I would bring here the latest monthly that we just dropped on the IAGAM web page. So of course, we publish that in a monthly fashion. This one is a bit longer. That's the outlook for the year. I strongly encourage that you go take a read. It's a bit longer. It's over 10 pages this time. Usually we tend to stick to about 5 or 6 pages, but you'll have all of our thoughts for the year, and we ask the 5 most important questions for markets and macro in 2025. The first one is, what does Trump 2.0 actually mean? The second one is, can China enact the much needed reforms and get out of the balance sheet recession that they're going through now? The third one is Europe an opportunity or a value trap? Fourth is, well, how low can the Fed and the Bank of Canada cut? We think that the Bank of Canada can cut a lot more. I think the market will be pricing out the Fed in the short run, but eventually the Fed will have to catch up. And the fifth one is, well, will we continue to see US dominance in the stock market, US and tech, or will we see rotation to other sectors and other geographies? So you'll find all of this there, and also a few suggested trades for 2025. Some that we don't think were that original, some more consensus trades like staying overweight equities throughout the year, but also some contrarian trades like shorting gold, going long the Canadian dollar. So everything is there in the piece, but let's maybe look at a few elements here that support some of our views and how they're evolving even today from this piece. So the first one is, well, what does Trump 2.0 mean? Well, the bond market is telling us part of the answer here. And rates are rising pretty quickly. And when we're looking at this chart here on the left, the feeling is that the market is looking at 5% on a 10-year rate in the US at least. The direction seems to be set, and when you talk to investors on the street, there's this feeling that the market wants to go to 5%. But we can decompose the 10-year rate and see what's driving it. So on the right, you have the three components. So on the left, you have the 10-year rate, and on the right, it's a decomposition. And if you add up all of those three parts, you return to the 10-year rate that's on the left. So the first line on the top right is the 10-year inflation expectations, or technical terms, the break-evens. What you're seeing in this chart is since September, when Trump started to take a solid lead in the polls, inflation expectations went from about 2% over the next 10 years on average to about 2.4%. So that's quite a shift over the next 10 years. So markets are seeing Trump as being inflationary. That's number one. Second line is the term premium, which is a construct that is catching everything that has to do with the stance of the monetary policy, or the Fed, in the US. And when the line goes up, that means that the Fed will be more on the sidelines, more hawkish. And since September, and again since also the Trump win, and now that we're getting some of his proposal and the rhetoric from Donald Trump, he said the line is going up and up and up. So about 70, close to 100 basis points of the rise in the 10-year rate comes from a repricing of the Fed. And as I said this morning, following the jobs report in the US, which was a blowout, now markets are pricing out the Fed until the fall. So there's a big change here. And the last line, which is very interesting, it's expected real growth over the next 10 years. As you can see, markets are discounting growth now over the next 10 years. So markets are sending the message that Trump might be actually neutral to negative for real economic growth. So this is what we're getting here. What can we expect from Trump? Of course, we can expect trade policy that's going to be very active, that will create inflation, that will cause a problem for the Fed to tackle this inflation, but will it really be bullish for the economy? Markets are thinking not. And when we look at what the Fed is priced in to do now, well, all the other central banks, like the Bank of Canada and the ECB that I brought here, but I could have brought more, they're seeing continuing to cut, getting close to their neutral rate, sooner being already there, almost. Like for the Bank of Canada, we tend to be at the top end of the neutral rate already, but the Fed is seen as being on the sidelines and being far from the neutral rate. At some point, there's self-stabilizing elements in macro, and if you have rates that are higher, you have the Fed on the sidelines, that means you have higher borrowing costs, and that means that eventually this will be a headwind to the economy, and the Fed will have to cut because the economy will be weaker than expected. So the market seems to be discounting that for now. So we think at some point in 2025, expectations for the Fed could be revised lower. And if rates continue to rise in the short run, and then at some point the consensus shifts to a much more dovish Fed, could be a very interesting trade in bonds at some point in 2025. So we're looking at this daily, trying to find exactly the right entry point. But we feel that at some point there's going to be a great trade to be made in U.S. Treasuries, and we'll keep you posted as our thinking evolves. Now for Europe, Europe is not the most sexy situation, but still there are some tailwinds and there are some headwinds. On the left, the tailwind, we mentioned that I think the last review of December, I think I brought this chart. The credit cycle is accelerating, so that's good news. This is hard data, which is something that we know. It's not speculation about Trump, what Trump will do. Households and businesses are starting to borrow more, so this is a good economic sign. But on the right, labor productivity is hurting, just like Canada. So the gray stick is Germany, red is Canada. So Europe is in a difficult situation, just like Canada, in terms of productivity. Targeted tariffs could hurt, and of course we're thinking about, will Trump go with tariffs in Canada or not? There should be some tariffs. They could be more targeted rather than blanket tariffs. But one thing that seems to be sure and very consensus is that there will be tariffs on European auto industry. And with weak productivity in Germany, that could hurt quite a bit. So let's see how things unfold. But it's hard to be very bullish on Europe this year. the stock market is cheap in Europe, but the expectations for earnings growth is also pretty low. So maybe there could be some bursts of opportunities throughout the year, but let's just say that Europe is not at the top of our list, or not even in the top part of our list of the most attractive bets on the equity side in 2025. Now, getting back to valuations in the US. So on the left here, you have the cyclically adjusted price earning ratio, so a long-term view of valuations. And now we're pretty much in line with the previous peak that we had, which was during COVID, but we're still far from the dot-com bubble, but still historically it's very expensive. Now, in the short run, valuation is not a good indicator for any strategies. This is well known, but in the long run, and we don't have a ton of data about elevated valuation, so it always needs to be taken with a grain of salt. But what you see on the right is that when you have valuations that are elevated, typically over the next 10 years, annualized returns tend to be pretty low when the starting point is this high for valuation. Now the question is, well, we have AI now, we have new technologies. Even if the valuations are expensive, earnings growth could be strong. Maybe you need to keep an open mind for all of this. But historically, what that tells you is that there's already a lot in the price, and there's less prospects for growth in the next 10 years. So we're still overweight US equities for now, but we're just cognizant, and we want to share this analysis with you, that valuations tend to suggest that geographical diversification over the next few years could be a winning strategy. Japan, Canada, for example, are rather cheap, and they have EPS growth expectations that are interesting, decent. So there's an argument to be made that other countries could outperform the US stock market over the next 10 years. Again, it's just one argument. Let's see how things unfold. But valuations matter in the long run. And this is noteworthy to see how expensive now the US stock market has become. So, current positioning, you have the table on the right. You can pause this and look at it, or you can go on my LinkedIn page and download the PDF. You can do that every single week if you haven't done so. But just to summarize where we stand on the macro front, 2025, the economic outlook supports an outperformance of equities again. So we're still bullish on equities in the short run. Valuations, we feel that the US appears expensive, but Canada and Japan are offering interesting opportunities. It's not just about valuation, so we're overweight Canada, but we're neutral elsewhere right now. Momentum, well, equity and rate momentum could be sustained post-election, and this is what we've seen so far. So we could have more momentum that continues to push rates higher, so negative for bonds, but also stocks higher. And sentiment is rather neutral at the beginning of 2025, which is supportive of further gains. Positioning is potentially stretched in some segments of the markets. So again, calls for caution here. So markets will not return 25% every single year for sure, but we're still thinking that we're looking at the positive year. It's going to be an eventful year, volatile year. Let's see what happens on the political side. We'll be keeping you posted every single week on how our views evolve, but right now we need to look at the facts and what we know. And when we have more knowledge about the policies that come in the US, then we'll adjust accordingly, and you'll be the first to know. So it's always a pleasure to serve you. If you appreciate the content, please share. Of course, come back again next year when we're back to the regular format of the Weekly Economic Review.